Hey everyone, and welcome back to our channel. In today's episode, we're going to be talking about one of the most important topics for anyone who wants to secure their financial future: investing for beginners. If you're new to investing, you may be feeling overwhelmed and unsure of where to start. But don't worry, I'm here to help you get started on the right path. The first step to successful investing is understanding what it is and why it's important. Investing is simply putting your money to work for you to make it grow. By investing your money, you can earn a return on your investment, which is the profit you make from it. Investing is important because it can help you achieve your financial goals, such as retirement, saving for a down payment on a home, or paying for your child's education. There are many different types of investments, but the most common ones are stocks, bonds, and mutual funds. Stocks are shares of ownership in a company, and when you buy a stock, you become a part owner of that company. Bonds are loans you make to a company or government in exchange for interest payments. Mutual funds are a type of investment where a group of investors pool their money together to invest in a diversified portfolio of stocks and bonds. Now, let's take a closer look at each of these investments. Stocks are considered to be riskier than bonds because their value can fluctuate rapidly. However, they also have the potential to offer higher returns over the long term. Bonds are generally considered to be safer investments because they offer a fixed interest rate, but they also have lower returns. Mutual funds offer diversification, which means your risk is spread across many different stocks and bonds, which can help minimize your risk. When deciding which investments are right for you, you need to consider your goals, risk tolerance, and time horizon. If you're young and have a long time horizon, you may want to consider investing more heavily in stocks because you have more time to ride out any market volatility. If you're closer to retirement, you may want to invest more in bonds to help preserve your wealth. It's important to note that investing always involves some level of risk, and there's no guaranteed way to make money. However, by investing wisely and diversifying your portfolio, you can help minimize your risk and increase your chances of achieving your financial goals. Now, let's talk about how to get started with investing. The first step is to set up a brokerage account, which is where you'll buy and sell your investments. There are many different brokerage firms out there, so it's important to do your research and find one that fits your needs. When you're ready to start investing, it's important to start with small amounts of money and gradually increase your investment over time. You should also diversify your portfolio by investing in different types of investments and different companies. One thing to keep in mind is that investing isn't a one-time thing. It's important to review your investments regularly and make changes as needed. This is called rebalancing your portfolio, and it helps ensure that your investments are still aligned with your goals and risk tolerance. Here are some potential investments that could be included in a 20-year investment portfolio. Stocks. Investing in stocks can offer higher returns over the long term, but also comes with more risk. Some examples of companies that could be included in a stock portfolio for a 20-year yield are Apple, Amazon, and Microsoft. Bonds. Bonds are generally considered to be safer investments because they offer a fixed interest rate. However, they also have lower returns than stocks. Some examples of bonds that could be included in a bond portfolio for a 20-year yield are U.S. Treasury bonds, municipal bonds, and corporate bonds. Real estate. Investing in real estate can offer both income and long-term capital appreciation. Some examples of real estate investments that could be included in a portfolio for a 20-year yield are real estate investment trusts, REITs, and rental properties. Mutual funds. Mutual funds offer diversification and can be a good option for those who want to spread the risk across multiple investments. Some examples of mutual funds that could be included in a portfolio for a 20-year yield are the Vanguard Total Stock Market Index Fund, the Fidelity 500 Index Fund, and the T. Rowe Price Blue Chip Growth Fund. Exchange-traded funds, or ETF, are similar to mutual funds, but they trade on an exchange like a stock. Some examples of ETF that could be included in a portfolio for a 20-year yield are the SPDR, SP 500 the iShares Core US, Aggregate Bond ETF, and the Vanguard Real Estate ETF. It's important to note that these are just a few examples of potential investments that could be included in a portfolio for a 20-year yield. The most important thing is to do your research, consult with a financial advisor, and make investment decisions based on your individual financial goals and risk tolerance. Investing can be a complex topic, but it's important to understand the basics and get started early. By investing your money, you can grow your wealth and achieve your financial goals. Remember to do your research, diversify your portfolio, and start small. And always remember, investing involves some level of risk, so be prepared to weather market ups and downs. Thanks for listening, and I'll see you in the next episode.